This is a download from BFM 89.9, the business station.
So good morning, Dodge. The October job numbers were very good coming out of the United States. 271,000 were added to jobs. This is one of the biggest gains this year that exceeded all estimates. And the jobless rates also fell to a 7-year low of 5%. We had a very good climb in average hourly earnings. So does this point to the inevitability of a rate hike?
Good morning, Julian. Well, this is an unambiguously strong report. The Fed has done what it can to prime global markets for the possibility of a rise in short-term interest rates in December. It would now take a catastrophically bad jobs report for November for the Fed not to increase. You have Charles Evans, the generally dovish president of the Chicago Fed, yesterday describing the numbers as very good and indicating he was going into December's meeting with an open mind. You have 7 FOMC speakers this week, six of them on Thursday. I would say it would be really very difficult for the Fed not to increase rates at this point.
And how big would you say this kind of data is? How influential are these data, the kind of data that is being looked by the Fed to guide them to whether to raise rates or not?
Very influential. Jobless rate, as you said, is down to 5%. It's just 0.1% above what they view as normal longer term. The number of unemployed dropped by 1.1 million. The average hourly earnings rate rose 2.5%. All these are positive. You also have a report that has some early signs of acceleration in salaries, supporting the Fed's basic case that as the labor market tightens, gains in wages and prices will accelerate. Now, the Fed has not set accelerating wages per se as a precondition for rate rises, but it does see the data as an important indicator of labor market slack. So, the rate of hiring in October is far above what is needed to ensure a continued decline in unemployment. There is one weakness, and that is the participation rate. But overall, the factors that the Fed has been looking at, plus the salary acceleration, are all quite positive and support a rate increase.
People would now be turning their attention to how fast and the kind of pace that the Fed would adopt to raise interest rates. Do you think that economic numbers are sustainable? And give us your view as to this pace of interest rate rise.
Sustainability is definitely a question mark. There are some headwinds. But one, the Fed has to start, and then the perception of the market will be very, very different. Number two, the Fed will have to prove it doesn't have to happen every month. So I suspect near the beginning of the rate rise, you'll have a month where there is no rise, only to prove to the market that it doesn't happen to have to happen every month in order for it to persist and to be sustainable. Also, they have talked about this. Yellen has talked about the increases will be very minimal. So we suspect, in addition to a month or two, or maybe even more, but at least 1 month when there is no increase, the increases will continue to be very minimal. If all that can persist, then I think it is quite likely that interest rates will be sustainable over the longer term.
Now, so people are expecting 25 basis points by December. And what happens after that, Dodge? Are we going to see perhaps a 1 percentage points rise over the next year or so?
1% is huge, yes, relative to where we are, Julian. But as you said, over the next year or so, that's what makes it possible. But I suspect it will be less than 1%. There's something visual about 1% over a year, so that will, if there is a 1% or more over the 12 months starting let's say starting December, so for the full year of 2016, that visually will give a message to the market that economically speaking, that the U.S. economy is stronger than what was suspected. So that would be a plus. But I suspect that the Fed is going to be very wary about giving a different message than it's been conveying so far.
Also, from a market perspective, are we entering a phase where, good news is good news, where these good job numbers can cheer the market up rather than a negative reaction to the possibility of higher interest rates that these job numbers suggest?
I don't think so, Julian. Honestly, I think there will be pockets of benefactors to this. I mean, obviously, you take a look at Friday, the main beneficiaries were the providers of money market mutual funds, which have been entering which have had to eat the cost of overhead just to provide even a basis point of yield in order to keep the money in-house. Charles Schwab rocketed 6%. You take a look at some of the ETFs. The S&P Bank Exchange Rated Fund did well. The Financial Select did well. Banks are going to do very well. We're seeing Bank of America, Bank of Hawaii, Pinnacle Financial Partners. We also see Goldman Sachs. They will be benefactors short term. But you have to look beyond that. And there are two indications that we're going to be watching. First, bank lending standards actually are tightening, according to the Fed's latest survey of senior bank officers, which means that while big corporations can really raise billions in the bond market to fund takeovers or buybacks, medium to large companies face tighter lending conditions. Also, the impact of monetary policy with short-term rates around the globe near zero or even below is arguably greater on currency exchange rates. So the U.S. dollar is going to benefit. Well, it's going to jump. It already has, but relative to other currencies, it's going to be perceived to be stronger, and that tighter lending conditions and the higher dollar may prove more powerful headwinds for the U.S. economy and especially corporate profits than any small uptick in rates that leaves them historically low levels. So it's not clear. Also, we have an aging bull market where the buying power is still below the selling pressure, and so it's going to take a lot for the market to continue. Historically, the last couple of months have been incredible, so it's going to be a real challenge to continue.
Thank you. That was DodgeODorland, Chief Investment Officer for LandorandFuest Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, one subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limit 6, ends 8/25/12.